Hey everyone, in today's episode, I'm diving deep into the world of ESG investing, a topic that's been on the lips of many investors lately. My question is simple: does ESG really lead to better returns? And if so, how can we actually quantify these results using financial modeling? That's what we're going to explore today. I'll split this into 3 parts: the numbers, the story, and the visuals. If you're already familiar with the math, feel free to skip ahead to where we talk about the story and the visuals. Let's start with the math. We'll define 3 key concepts: alpha, beta, and the Sharpe ratio. These are all measures of investment performance, but they approach it from different angles. First up, alpha. In finance, alpha is the measure of a portfolio's performance after adjusting for risk. In simpler terms, it tells you how well your investment did compared to what you would have earned from a similar investment with less risk. Think of it as the extra return you get for taking on a specific investment. A positive alpha means your investment strategy worked well. The higher the number, the better. Then we have beta. Beta measures how volatile an investment is. It compares a specific stock's price movements to the overall market. If a stock's beta is 1, it's just as volatile as the market. If it's less than 1, it's more stable. And if it's greater than 1, it's more volatile. Low beta investments are considered less risky because they don't move as much up or down. And finally, the Sharpe ratio. The Sharpe ratio is a way to see how much return you get for the level of risk you take on. It helps you figure out if an investment's return is worth the risks involved. It is calculated by subtracting the risk-free return, like the return you'd get from a government bond, from the investment as return, and then dividing it by the investment as standard deviation, which is a measure of risk. A higher Sharpe ratio means you're getting more return for each unit of risk you take. Now, here's the key point. In this video, we're going to build 2 portfolios: an ESG portfolio and a non-ESG portfolio. We'll use real data and historical prices to simulate what it would be like to invest in these portfolios over the past 10 years. Then we'll use alpha, beta, and the Sharpe ratio to compare the performance of these 2 portfolios. The script for this episode will be an 8-minute breakdown. This will combine technical explanations with storytelling to keep the audience engaged. Now let's go through the script step by step. What is ESG alpha? Begin by defining ESG alpha. This is a new investment strategy that combines environmental, social, and governance factors with financial analysis to make better investment choices. Companies are ranked based on their ESG performance. The top ones get included in the ESG portfolio. The goal of the analysis now. Explain why you're doing this analysis. The goal is to find out if ESG investing leads to higher returns than regular investing. How to calculate alpha? Here's the formula for alpha, and break it down. Alpha equals R sub P minus R sub F plus beta times R sub M minus R sub F, where R sub P is the portfolio's return, R sub F is the risk-free return, beta is the portfolio's beta, and R sub M is the market's return. Measuring risk-adjusted returns now. Introduce the Sharpe ratio. This is a way to see how much return you get for each unit of risk. It helps you figure out if an investment's return is worth the risks involved. It is calculated by subtracting the risk-free return from the investment as return, and then dividing it by the investment as standard deviation, which is a measure of risk. A higher Sharpe ratio means you're getting more return for each unit of risk you take. ESG versus non-ESG portfolios. Explain that UV created 2 synthetic portfolios. One focused on ESG-screened assets, and the other tracking a broad market ETF, yield backtest, both analyzing their returns, volatility, and drawdowns over the last decade. You'll see which portfolio outperforms in various market conditions, such as during a bull run or a recession. Factor attribution to understand where any outperformance comes from. We'll use a three-factor model by Fama and French. This model looks at market risk, size, and value. We'll add an ESG factor to track how the ESG screen impacts returns. This will give a deeper insight into the cause of any performance differences. Visualizing the data, we've prepared for key visuals to help us dive deeper into this analysis. First, we'll look at a scatter plot comparing return versus volatility for ESG and non-ESG portfolios. You'll see how the risk-return trade-off compares. Next, we'll display a cumulative return chart showing the growth of both portfolios over time. After that, we'll show a bar chart comparing their Sharpe ratios. Finally, we'll dive into a table showing the alpha and beta for each portfolio. This will tell us how much of the returns can be attributed to market movements and how much is due to each portfolio as unique characteristics. Bonus insight before wrapping up. Let's discuss some quantitative insights. One interesting thing in ESG investing is its potential to reduce idiosyncratic risk, especially through good governance. Idiosyncratic risk is the risk specific to a company or sector. ESG investing might help reduce this risk because it takes into account a company's management, which can impact how well it handles problems. During times of market stress, ESG portfolios could perform better because they are more resilient to systemic issues. Furthermore, we explore if ESG portfolios underperform in bull markets but protect investors more during downturns like the COVID crash in 2020 or the market dip in 2022. Summarizing the main points and reiterating the key takeaway that ESG investing is not only about doing good, it's also about risk-adjusted returns and superior long-term performance. And that's the script. Stay tuned for the next episode where we'll dive even deeper into the world of financial models and market efficiency. Thanks for watching.